All right, what's up, tax pros? What's up, business tax verified members? Andy Fry here from Pronto Tax School, and we're here in tax season 2019. Sorry, my voice is a little bit hoarse. I'm in kind of under the weather, but I wanted to make you guys this video that shows you how to deal with a very common problem that comes up. A tax client will show up during tax season, an S corporation client, and has not paid a reasonable salary. And I just want to make this training for you guys to show you how to handle that. So this was the question that was posted by one of our best members. This pesky S corporation, no salaries were paid, and books show them operating at a loss. Overall, this member just feeling pretty stressed out. Please help, I'm losing sleep, and even turning pale over this. So one of the nice things about being in this program that we want to give to you guys is to take away some of those fears, especially if you're dealing with a real situation with a real client. And so we are introducing something called the Show Me How on-demand video training. And this will be actually the first installment of that. And it's basically an ability to post a question like this within the private group and use the hashtag Show Me How, and it's going to create a request on our end to provide you with some customized training. So we want to listen to you guys, see what you need, and provide the training based on your actual question. So this will be the first installment of that, but keep that in mind for other questions you have. So bottom line, no salaries were paid, now it's too late, and the client has showed up, it's tax season, the year's already passed by, right? So first thing is you gotta realize the advantage of S corporation, reasonable salary, the whole point of it for us as professionals and for our clients is that a chance to reduce the self-employment tax on some of the net profit of the company, right? So that's the big picture of why it saves the client money and why it's frequently a good strategy to use. Now, in order for that strategy to be valid, the IRS rule requires that the company must pay any shareholder employee, so any shareholder that works in the employee, a reasonable salary, right? The company is not required to put itself out of business paying salaries when it can't afford salaries. So that is one of the main kind of stress points of feeling like, well, you didn't pay a salary, but you got to look at the overall profitability of the company. New companies and those with extensive debt repayment, for instance, so say they're paying off a debt and they don't have that cash flow to actually pay salaries, they are not required to go out of business paying a salary. Whether or not the shareholders have drawn out distributions or even drawn out money from the company is also an issue to consider as far as how much of a problem is it really or is it not that salaries have not been paid. So you got to kind of start with that big picture in mind. What's the profitability level of the company? Now, option one, depending on the net profit from the business, which is the key factor here, if that net profit, you guys, is less than what a reasonable salary would be, there's really no need to stress about reasonable salaries not being paid because there's no justification for separating the profits of the company from the labor of the shareholder employees. There's not enough room to even pay a salary and have any difference between the overall profit and the salary amount. And you guys have already dealt with S Corp, so I'm not going to get too deep into all the specifics of that, but I think you'll know what I'm saying when I say that. I'm hoping you do. If not, post an additional follow-up question. But in this case, if that profitability is not there to support it, you would handle it by marking any profit on the K1, if there is a profit, as self-employment earnings, and just make sure on the shareholder employee's personal tax return that you are using your tax software to mark those earnings as subject to self-employment tax, right? Because that is basically covering the payroll tax, covering the self-employment tax on those earnings. And at that point, you've done what you need to do as far as the IRS compliance side, and you basically have solved the problem. You do need to or should evaluate moving forward a possibility of paying a salary in the current year, depending on the profitability of the company. So the company is starting to ramp up profits. It's a great time to kind of look at that with the client and make sure they have some visibility and some good guidance moving forward. Also good to keep in mind when you're having that conversation about looking forward, that not all payroll needs to be a bi-weekly payroll, right? There's sometimes unconventional payroll of say the company is dependent on larger contracts that they get, right? Maybe there's a payroll run that happens when those payments come in from those contracts. And just keeping in mind that there are a lot of smaller companies and even larger companies that have uneven or unreliable revenue and profits, and being able to match up the payroll situation with that is kind of an advanced topic that we train on in this program. So keep that in mind. Option number 2, again, if the net profit of the business is more than the reasonable salaries of shareholder employees would be, then you could also evaluate the possibility of backdating a reasonable salary. For instance, issuing a 1099 from the company to the shareholder employee reflecting reasonable salary amount on that 1099 and making sure that the self-employment tax is paid on that amount on Form 1040. Now, is that a signed off on, way that you would want to repeat all the time and is just like something good to do? Not necessarily. There is a possibility of an audit. There is a possibility of the IRS saying, no, actually the entire profit needs to be subject to self-employment tax. There are also possible problems with state unemployment agency or other agencies that collect tax based on W-2 wages. And so another kind of way around that would be to mark the any profit on the K1. Actually, that was from the last slide. I'm sorry, you guys. I'm right in the middle of tax season, so I was doing this quick for you guys. Ignore that last one. The same result is achieved by marking part of the K1 profits as subject to self-employment tax, so self-employment earnings, and part not. So that would be another way to reflect, I'm going to pay the self-employment tax on XYZ amount so that I am covering my reasonable salary based on my work. And part of it is going to go on the K1, not subject to self-employment tax. So it's kind of a backdoor way to handle that. It's, again, these are not something that everybody would advise you to do. I'm not even advising you to do this. I'm just showing you kind of the theories of one of the ways that this can be handled. Make sure to CYA, as they say, and communicate with the client if you pursue either of these strategies about potential downsides and things that can happen, right? Option number 3, assuming that the net profit of the business is more than a reasonable salary. So again, same assumption as the last slide. A more conservative way and probably more technically proper way would be to backdate the reasonable salary by filing late W-2s, late 941s, essentially running payroll for the year late. Now, this is going to create large late filing penalties on the payroll taxes and a series of ongoing problems, including a lot of letters and issues. Any tax savings you're going to get on self-employment tax likely to be wiped out by payroll penalties and just overall dealing with a bunch of letters and issues that are going to come from this approach. So it's not a lot of fun to go this way. Nevertheless, it is an option worth mentioning, and it's probably the one that the IRS would prefer that you choose, as it is probably the most technically proper way to do it. And again, this is assuming that the net profit is enough to where it's even worth having this conversation in terms of trying to save on self-employment tax. So overall, the key is going to be proactive communication. S-Corp clients that show up during tax season not having paid reasonable salary is a common problem, and it's actually a great opportunity to show your professionalism, your care for the client, your training and support that you're getting in this program, and doing the best you can with what you have to work with, and then most importantly, proactively communicating about doing things right moving forward is going to be a very key. Most S-Corp shareholder employees who end up in this situation are not seeking to do anything illegal or unethical. It's just a very confusing set of rules, especially if for a newer business owner or someone who is filing a Schedule C sole proprietor, and maybe this is their first year or second year even having a corporation. Either way, our goal for you guys is always to be a hero by fixing the immediate problem as best you can with what you have to work with, and also showing a clear, better way forward. So I hope that helps you guys. It's a very common problem. Wanted to do a succinct training and just post this to the group. Remember, going forward, if you have other questions that you feel like you want some customized training, use that hashtag #ShowMeHow in your post within the private group. And can't promise we'll get to every single one, but we are trying to source new video trainings and things that we can be responsive directly to your needs based on what you're seeing in working with real clients. So that's the kind of program we want to make for you guys. Thank you for always being a positive part of the program. And yeah, have a great day. Let's do this.